Hi guys, Whitney here. I'm the Director of Investor Education here at PassiveInvesting.com, and I'm so excited you've joined me today. We are going to focus our conversation today on mastering the lingo of passive real estate investing. Now, if this is your first boot camp, welcome. Again, my name is Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And we do this monthly boot camp to focus on skills on how to be a better passive investor, or if you're just joining me for the first time on these boot camps, this is where we're going to kind of start from the very beginning and pick apart what passive real estate is, what do all these terms mean, and just how you can incorporate passive real estate into your portfolio. Now, this is the whole reason why I love passive investing, is because passive investing helps me, not only create financial freedom, but it also gives me the other freedoms in life, which is time freedom, choice freedom, location freedom, and freedom to make an impact in the world. And the pictures on the screen, if you're watching via video, you see pictures of my family and some of our travels from the summer. We love traveling in the outdoors. We have an amazing, one of these days I'm gonna have to show you my camper trailer that we have. It's like off-road clearance vehicle. It's amazing. But we have lots of toys. We love mountain biking, hiking, paddle boarding, and then just exploring the woods. So that's what we love to do. That's our passion. And passive investing helps us do this. So maybe you have a different passion. Maybe you love traveling extensively, like overseas, or maybe you love building, like you're in the process of building your own business, or maybe you're wanting to start a foundation someday. Passive investing can really help tap into you getting 100% control and choice on how you spend your time. Now, we personally in our portfolio, we have over 6,500 multifamily units or residential units, 2,200 self-storage units. And this is more of the investments that I'm more active in. I also have my passive portfolio on top of this, but all this together really helps drive us having 100% choice and control on how we spend our time. And if you're here, you're wanting to learn how to do the same. And so we can actually help you do that at passiveinvesting.com, either through debt, either through our real estate debt fund, which we've deployed over 350 million in capital through that fund, or in equity, which we have 1.4 billion assets under management. But what's the most important stat on the screen that's important to you is those $51 million in investor distributions. Now, today, we're going to be picking apart the lingo. We're going to go through some basic definitions of, say like you opened up an offering memorandum, one of those beautiful marketing documents. We're going to go through all the kind of crazy terms in there that you should be aware of. And then we're also going to get a little bit into the math towards the end of today's presentation. Now, this is education for you. It's not financial advice, legal advice, tax advice, or anything like that. If we come across anything you construe it as that, make sure to take it back to your investing team before making any investment decision. And if you love what you hear today, my invitation to you is to join our Passive Investing Club. There you get free access to additional master classes where we talk about all things passive real estate, as well as our skill building boot camps every month. You get priority access to our deals, and you can hop on a one-on-one phone call with me to discuss your passive real estate investing goals. So if you're watching this via video, you can scan the QR code and get registered. If you're listening to us on your favorite podcast player of choice, you can go to passiveinvestingwithwhitney.com. And don't forget to pick up my book, Money for Tomorrow, How to Build and Protect Generational Wealth. There we go through how to apply all the different pieces of information in there for you to not only create and grow your wealth, but to moreover keep it and be able to pass it on to the next generation. You can find that on Bigger Pockets as well as Amazon.com. All right, let's dive in. We're going to go fast and furious through some of these terms, and we're going to start with the basics. So passive income. what does passive income really mean? Well, there's two different ways to consider passive income. One is, how does the IRS look at passive income? All right. Income that is earned passively through investments, not actively through trading time for dollars, that gets the best tax treatment. All right. Now, there's this kind of gray area here, right? If you invest in a note fund, that technically is considered active income. Okay. Because you're actively lending out your own money in order to be the bank on the project. All right. But anyway, so we can think of it, how does the IRS deem it, right? I can have 40 single family rentals, which I've had before, and that's all considered passive income. But it was not passive with my time. That's the other way to look at passive income. What is your time involvement in here? Because the more time you have to put in, the lower your return on your time. Okay, we all the time talk about cash yields, ROI, return on your investment. We have to be able to calculate our return on our time. If that is important to you, some people love real estate. They want to be active. But if you are like, man, I've got a higher and best use of my time. I've got a family. I've got a business. I've got all these different things that I need to attend to. I want my passive income to be truly passive, according to the IRS, but also passive with my time. Okay, so we can either be passive active or passive passive. All right, now syndication. We hear this term thrown out there. Syndication really just means a group of people that come together to purchase a large piece of real estate property. Now, syndication in and of itself just means a group of people. Like we've heard of crime syndicates. Maybe mob bosses are in charge of a crime syndicate. It just means they're in charge of a group of people that are committing crimes. In this case, we want to have a group of people that come together to purchase a property. And it can be through real estate notes, it can be through preferred equity, it can be in express car washes, apartments, self-storage units. All right, it can be whatever, they're going to come together with their collective purchasing power to take down. All right, so we talked about passive income. We've talked about syndications. Let's talk about active versus passive investing. Okay, and let's get a little bit more granular about that. If you are in an active role, you're finding a deal, you're managing the deal, you're figuring out the financing on the deal. Okay, so in the term, if we're talking about syndications, this would be the general partner. All right, now if you're passive in a deal, that means you're not doing any one of those three main active activities. You're not finding the deal, you're not managing the deal, and you're not financing the deal. Okay, you might be bringing money to the table for the down payment, capital reserves, something like that. That means you're passive in the deal. Okay, so why does this relationship work between active investor and a passive investor on a syndication? Well, a general partner, okay, the active investor, otherwise they can also be referred to as the operator, sponsor. There's a little bit of nuance between those words. But they have the deal flow and the ability, the desire to manage the deal. They have the time, they got the people, the systems, the lending, the credit, but they either want or need capital to take down the deal. All right. Now, the limited partner or the investor, they opt to take a passive role, because remember, we wanted a higher ROT, return on our time, to focus on other areas of real estate, maybe that we want to be in, or scale a business, or our day job, or to focus on our family, or focus on ourselves, right? So that limited partner investor actually has capital to place, but they don't have the deal flow. Okay, either they don't have the deal flow or they don't want to put the effort in to go find the deal flow. And they don't have the ability or don't want to have the ability or desire to manage the deal, which is the time, the people, the systems, and lending and credit. So these two, pieces, the active and passive, kind of fit together like a nice little puzzle in order to form the syndication to take down the deal. Okay. Now we have leverage. There's another term when we talk about passive real estate. So it can be leverage as far as lending, but we can even talk about it a little bit deeper, leverage as a passive investor. You are leveraging, when you invest in a passive real estate deal, you are leveraging an operator's knowledge of the strategy, their market, the underwriting, the lending, their expertise, including the track record and all their business systems, team of brokers, their property managers, their lenders, their accountants, legal, their ability to get credit and secure the loan. You're even leveraging their ability to raise capital from other investors to take down a deal like this. And you're leveraging their time that they put all that time and energy and attention they put into this deal to underwrite it, complete the due diligence, and actually run the deal. That's some immense amount of leverage here. All right. So now that we kind of understand what a syndication is, what passive income is, who are the players in a syndication, how does this all kind of work together? Why do people even consider putting their money in a syndication? Okay, let's talk about the different layers of money in a syndication. We call this the capital stack. All right, and we'll come back to this and dive a little bit deeper later in the presentation. But really, the question here is, do you want to be on the debt side or the equity side? Do you want to be the bank? Do you want to be the partner? Okay. So the capital stack shows you all who's the bank, and it shows you who are the partners. So it represents the different layers of money that go into a deal. So where do you want to be in the capital stack? Where do you want to invest? Now, we used to, people in my role, marketing roles, director of education, investor development, even investor relations, we used to help people understand that you could diversify over operators, markets, and deals. As a limited partner, past that, you were kind of tied. You were giving up day-to-day operational control, so you had to diversify in those three areas. The last 2 years has taught us that you have to diversify across the capital stack. So it's not just the deal, it's the operators, the market, and the capital stack. You have to have, in order to have a smooth ride and to be an all-weather portfolio, you need to have deals in the debt layers of the capital stack, and if you want growth, in the equity layers of the capital stack. Okay, so why is this? Why all layers, right? Well, the debt tends to be lower potential risk as well as lower return, but stability of cash flow. Okay, priority and security. Okay, the equity layers tend to be higher in potential risk and higher returns. Okay, we all love the high returns when it works, right? But sometimes we hit markets that are a little bit challenging. Now, we want to go into high quality deals, absolutely. But again, we want to balance out the cash flow stability with the growth potential. So here's a brief, real quick example. One investor that I coached recently, and they said, I don't know what happened to my portfolio. I was in self-storage, mobile home parks, residential assisted living, multifamily, and they this last 2 years has been bananas. I don't know what's happened. I thought I was diversified across the operator, various markets, even the asset type, but they were all in the equity portion in the capital stack. Okay, so just imparting that, it's not debt versus equity, it is both. What is your balanced blend going to be? All right, here's another term that kind of trips people up when they're getting into passive real estate investing is accredited investor. What does that mean? Well, an accredited investor is actually a Securities and Exchange Commission term, and they define it as somebody who has earned income of $200,000 or more for the last 2 years, or $300,000 or more for the last 2 years with their partner. Okay. And it can be a spouse or a spousal equivalent. And it's, for the last 2 years and reasonable expectations going forward. Or they can meet what we call the net worth test, which is they have a net worth of $1 million or more outside the ownership of their primary real estate, meaning we got to back out that that primary house, the roof over their head, and then see, do we have a net million there? Or they hold in good standing a Series 7 license, Series 65 or 82 license. All right, now there's some other, different qualifications in here, but those are the big three that most people qualify for to be an accredited investor. And you don't have to have all three. You just need one, okay? Here's the catch. You have to be able to prove that you're an accredited investor. So if you're not accredited, if you don't meet one of these tests, then what are you? Well, then you might fall in what we call the sophisticated investor camp. Okay, and that sophisticated investor means, you can't prove that you're sophisticated, but you're going to sign a legal document saying, I've got enough money and enough knowledge that if I invest in this deal and I lose it all, I'm going to be okay. All right. So, and there we go. A sophisticated investor is somebody with high net worth and extensive knowledge and experience in the investment. All right. So, most deals in the private equity space generally are tailored to the accredited investor. Okay, now it's not to say that you can't find one for a sophisticated investor. You can, but there's generally just very few spots, maybe 35 spots in any one deal for a sophisticated investor. Okay, so this is why a lot of early investors, people who are getting into the space that aren't quite accredited, they tend to take a little bit riskier positions in order to hit that accredited status early. So again, keep this in mind. That works in certain market cycles, not in all market cycles. Okay, we want to do this safely. All right, offering memorandum. What does that actually mean? All right, an offering memorandum is really the document, the marketing document that states the objective risk in terms of an investment. Okay, now it generally has the financials, all the biographies of all the partners and members of the general partnership, maybe some of the team members too. It also includes the business plan. Now, it shouldn't be confused with the PPM package, the private placement memorandum. Okay, so if the offering memorandum consider it the marketing, the PPM is the legal. We want to make sure that what's stated in the offering memorandum, all that information actually aligns with what's in the PPM package. Now, the PPM package isn't just the PPM. It's actually, we kind of loosely, use that term to represent three different documents, which the PPM, package includes the subscription agreement, the operating agreement, and the private placement memorandum. So the subscription agreement outlines all the terms and conditions and the commitment of that investment, including the amount that you are investing, your accreditation status, and any restrictions there might be for transferring your shares. Okay. The operating agreement outlines the terms of the partnership between the general partners and the limited partners, including all the profit and distribution and decision-making decisions. Okay. It says, okay, if the subscriptions this is how much you're investing. Under what terms, the operating agreement goes, now you've invested this much, this is who gets to make all the decisions. This is who's operating what. And then the private placement memorandum actually outlines, again, some of the terms, but the risk and the objectives of the investment. And this all combined is your legal package. Now, it can be somewhere between 70 to 120 pages. A lot of limited partners don't read the entire thing. I really encourage you that you get familiar with all the packages. And anytime you invest, especially with a new operator, sit down, read it through, ask your questions. Okay. So here's kind of a compare and contrast between offering memorandum and private placement memorandum. Offering memorandum is going to be the marketing, property details, the visuals, comparable analysis, everything about the property itself and the business plan and the team running it. Okay. The private placement memorandum is going to be pretty much everything about who's pledging what dollar amount, who gets to make the decisions, who's qualified to do what is everybody's rights and obligations, what are all the legal disclaimers, and then it checks all the boxes for regulatory filings. All right, so those are some of the beginning basic lingo. So what is passive investing? What is a syndication? Who are the players in the syndication? What documentation am I looking at it? What does it actually mean? How can I find pieces of information, as I'm investing? Now let's start getting into the math lingo, as I call it, kind of the 201 lingo, the second level. And I'm going to break this up into returns and then hurdles, okay? Because I think passive investors sometimes confuse the two between returns and hurdles. Now, again, this information should be outlined in the offering memorandum, okay? So again, remember that offering memorandum is going to have, the business plan. And so it will list out the returns as well as the hurdles. It should also, the offering memorandum, dive deep into the capital stack, okay? So however the offering memorandum outlines the capital stack, that should mirror exactly how the capital stack is outlined in the legal documentation, okay? The offering memorandum should also tell you what the cash on cash is, okay? That is an actual return, okay? Now, remember, the offering memorandum is the operator's researched best scenario guess of how they're going to navigate the project. All right. If you're in an equity deal, we're partners. We're going to make money together through challenging times. We're going to also have to figure out a way how to, keep the property afloat. Now, so cash on cash, we're going to make decisions based on the best projections. So you as a limited partner need to make sure that you are trust, but verify all the data in that offering memorandum. Okay, so we'll get into sensitivity analysis, here, but let's start with cash on cash. Cash on cash is going to be one of those real returns that you can make a decision off of. And that is simply what's the ratio that compares the annual pre-tax cash flow from a property to the total amount of cash that you invested in the deal. Okay. And it's calculated after, typically after debt. Okay. So for a limited partner, your calculation on cash to cash is pretty simple. If I put in $100,000 and I'm expecting to get $7,000 the first year, my cash on cash is 7%. Okay. Now, then we get into capitalization rate. Okay, this is a ratio used to estimate the potential return on an investment property, calculated as the net operating income divided by the property's current value. Essentially, this would be the cash on cash for the property if there is no debt on the property. So this capitalization rate isn't calculated at your level or my level as a limited partner. It's calculated at the asset level. So if the asset, say a multifamily building, throws off, $100,000 and its current market value of the asset is $1 million. Remember, because the value of the asset doesn't change whether we pay for it in all cash or whether we take out a loan on it as an operator. Okay, so the value doesn't change, but the returns will if I take out a loan. But if I take that, then my cap rate would be 10%. $100,000 divided by the current market value of the asset, as a percentage, that would be 10%. Okay, that's a really great cap rate, by the way, but I wanted to keep the math simple. Okay, so this is an amazing way for you as a limited partner to kind of, compare, projects. What is the going in cap rate of the project? We're going to execute a business plan. It's going to take 2, 3, 5, 7 years for that business plan. What is the expected exit cap rate? All right, so that's a great way for you to kind of compare projects without all the debt and everything getting involved in any of those calculations. All right. Here's the thing. Cap rates, the projection of a cap rate is, again, the operator's best guess of what's going to happen in the market. So again, we're going to draw our eye back to sensitivity analysis, stress test everything here in a little bit. All right, so those two numbers really represent the true returns that we could, expect to see on a project. All the other numbers are going to be projected returns. Okay, so here's an example of a pro forma. So, basically all the income that's coming in, all the, rental income that we can expect coming in, all the expenses that we can expect going out, and then how does that, what are the projections that we're making over year 1 through 10 of the asset? So pro forma is a financial projection of the real estate property's income, expenses, and profitability over a period of time. Okay. So we're gonna make some best case projections, right? We're gonna, analyze the opportunities for us to increase income, opportunities for us to decrease expenses. Do we need to add more staff? Maybe we have to increase advertising and property management staffing at an asset. Maybe we need to research when the taxes are going to be renewed, and are they going to increase? All of those calculations are going to go into here. Now, that's going to impact the again, various returns on the project. Okay, that pro forma analysis. So we can kind of get an idea of like cash on cash in today when we close on the asset, and then we're going to get projected cash on cash going forward based on our pro forma. What levers are we going to pull to either increase income, decrease expenses, or add additional streams of income to the property? Okay, then now we get our cash on cash return projections moving forward. All right. Then we got our friend here, the internal rate of return. All right. So between internal rate of return and annualized rate of return, internal rate of return is a calculation. Essentially, it's the rate of return that you could expect to make that would make the present value of the future cash flows plus the final market value of an investment opportunity equal to the current market price of the investment or opportunity. So it's the higher project's internal rate of return, the more desirable the project is to undertake. All right, so it takes into account cash flow, time, meaning the holding period, and what the present value of the asset is. What tends to be a little bit easier for people to kind of wrap their head around is the annualized rate of return. Okay, that is the average annual return excluding disposition. And then there's the annualized average rate of return including disposition. So the annual rate of return excluding disposition is going to be the return per year during the investment hold. It does not include your return of capital, I should say. And then your annualized rate of return including disposition, that actually will take into account your return on return of your capital in the investment. The end take-home message between IRR and annualized rate of return, the higher those numbers tends to be, especially in an equity deal, the more desirable a project is to take overall. Now, we still have to go back to what kind of risk are we willing to take as a limited partner investor? That is a very real question. Okay. Now, if I'm going to compare numbers project to project, out of all of these, cash on cash, annualized rate of return, internal rate of return, I'm going to take the internal rate of return to compare numbers project to project because it bakes in time. So I can compare a project with a whole time estimated to be 5 years and have that IRR, and then one that's 7 years, and that's a number that I can compare on is the internal rate of return. The others I cannot, because they don't take into account time and when you get your return on capital. All right, equity multiple. This one is the total cash distributions received from an investment divided by the total equity invested in a deal. Okay, essentially, it's how much money an investor can make on their initial capital investment. All right, again, remember, look at the equation. If you're watching on via video, this does not take into account time. So I cannot take the equity multiple and compare it to another deal of a different time length. That won't really work. You can only compare equity multiples of deals of the same hold time length. Okay, so we had our real returns, then we have our projected returns. What are all those assumptions we're making based off the pro forma? And what are the returns, that we might be able to calculate over time? Now we've got hurdles. Now, if you are sitting here and you're pretty new to passive investing, you're like, Whitney, you have not said preferred return. Why is that? Well, a preferred return is not a return at all. It is actually a hurdle, okay? But before we can get to that, we need to understand how the preferred return actually works. And that is because it's based off the distribution waterfall, okay? So the waterfall, this is going to be laid out. You might get some of that information from the offering memorandum. It is definitely going to be laid out in the private placement memorandum. Okay, the legal documentation. The waterfall simply states who gets paid what and when. Okay, it determines who, how, and when a partner, limited or general, gets paid in a passive investment. Okay, again, you'll probably get a small statement in the offering memorandum, but a larger layout in the private placement memorandum. Okay, so if we are reading the waterfall, the preferred return is part of the waterfall. Okay, preferred return, also called pref, is a minimum rate of return or threshold that an investment must reach before incentives are paid out. It is a hurdle rate or required rate of return. So if we look at a partnership structure in this for cash flow, in this particular deal, the preferred return is 7%. So it means the first 7% of returns on that deal coming from cash flow get paid to the limited partner before the general partner gets to start participating in the split on the cash flow. All right. All right. We'll talk about the membership ownership part here in a second. Now, you need to watch out for what we call general partner catch-ups. Here at passiveinvesting.com, we do not do GP catch-ups. However, it can be a sneaky thing that gets slid into some deals. Now, it is not illegal, okay? And in some cases, there might be a really good reason why the general partnership put that in. However, for you, if you see a general partner catch-up listed in your private placement memorandum, you're going to want to ask more questions because you want to make sure you, as a limited partner and the general partnership, are aligned in the deal. Okay. All right. So another part of this waterfall is what we call the general partnership split or the GP split. And that's the percentage of profits that a GP is entitled to earn, also known as the carried interest. And, this is so because they're, taking on additional work such as finding, vetting the deal, managing a deal, and overseeing the ongoing investment of the deal. Okay, so the GP split in this case for the distribution cash flow is going to be 70-30. On the membership interest, the GP does not get any split. So whenever the asset sells or repositions, capital start getting, distributed back to investors, original capital. 70% after the original capital is distributed, 70% of the profit will go to the limited partners until we hit our next hurdle, which is 13% IRR. And then the general partner gets to participate in the GP split of 50-50. Okay, so in this case, this deal has one hurdle, which is the preferred return, and another hurdle, which is the internal rate of return. Okay, so here we're looking at the sensitivity analysis. Okay, so remember early on when we were talking about cash on cash, cap rates, internal rate of return, and we're calculating, in those slides, we were looking at a single number. But that's really not the case. We want to actually, we want to make sure our general partner is actually looking at multiple types of scenarios that could happen. And we want them to put out a projection in each of those scenarios. So they're really going to calculate a projection of what they think the cap rate's going to be in the future, what the internal rate of return will be in the future, the equity multiple, the cash on cash. So the sensitivity analysis is a method that takes into account several factors that impact an investment property's return and helps you calculate how a change in each of those factors would affect profit. In this case, what we're changing here is the cap rate and how that would affect the return on disposition. Okay. And because as we change the cap rate, then the money that gets returned to the partnership changes, the internal rate of return changes, the equity multiple changes, the average cash and cash changes, as well as the annualized return. This is how I tell investors to look at this. When you're looking at a sensitivity analysis, okay, don't get starry-eyed by the single numbers presented at the very executive summary of a deck, like the one-pager. You got to read the whole offering memorandum. Look for the sensitivity analysis and see, are you comfortable with the returns across the various changes in the cap rate? So if the cap rate is going higher, that means the market is getting worse, the market's expanding, okay? If the cap rate compresses, which is what we all want the cap rate on our asset to drop, but if it does that, what does the return looks like? Okay, so on this particular asset, the cap rate was 4.2%. Okay, that was the entry cap rate for this asset. So there was the operator put in a one-liner saying, okay, hey, this is what it looks like if at 4.22%, if it just held, these are the projected returns. If the market got better, here is the projected return. But if the market starts expanding, here is how the returns look. Okay, we want to make sure that operators are doing sensitivity analysis. Now, there used to be a rule of thumb that if, for every year of the hold, you wanted to see at least 10 basis points or a 0.1% expansion in the cap rate. Meaning, in this case, if I'm entering the deal at a 4.2% and I'm holding the deal for 5 years, that I wanted to see a cap rate expansion calculation at least to 4.7%. All right. There's really no grounding for that calculation, 10%, 10 basis points per year. So, make sure that I would, challenge that your operator needs to be going, at least 0.75, if not to a full percentage point expansion above, and calculating that sensitivity analysis and showing it to you. And here's the thing, if you don't see it in the offering memorandum, it doesn't mean that they haven't done the calculations, just ask for it. All right, guys, we are going to open up the floor to questions. So this is the time to go over to the Q&A box, the chat box. First of all, tell me, what did you love? What would you love to see? I also, if you're here, I want to know, what is a takeaway that you have? How are you going to take this information and integrate it into your knowledge bank, into your investing plan? Because the worst thing you can do is watch a webinar and then not take away something in order to make a change for the better in your investing. All right, guys. If you are here live, I'm going to switch over to the Q&A. If you are watching on video, this is your invitation to join the Passive Investing Club. You can scan the QR code below or visit passiveinvestingwithwhitney.com.